Hey everyone, it is your BFFF, best financial friend forever, Eric Miller, back with another podcast. And today we tackled investing in private equity. It sounds sexy. It sounds great. It's one of these things that, once you get to a certain level is probably something that you should look at. But like any other investment that you make, you have to be very, very careful before you dive into this. So this is something that we went over with my advisor, Eric, and another Between Two Erics that we did. And we dived into what a private equity deal is, the risk that you may take, whether or not you're qualified to do it, and the parameters that we would look at, whether before we made a recommendation for that. And just making sure that you don't think that these investments are going to, save you in any way. I mean, you really have to invest in these when you're in a very specific financial condition. So I think you guys are going to enjoy this. And as always, I invite you, please, need your support. Please share, subscribe to the podcast so we can continue to do these things and know that we're making an impact on healthcare owners. And as always, if you need any help at all, anything at all, please reach out to us. You can go to our website, econologicsfinancialadvisors.com, and you can schedule an intro call. Okay, I'll see you guys on the next podcast. What's the debate today?
Private equity. Private equity versus, call it public equity. I don't even know if it's a versus situation. I think it's just a discussion on what is private equity, because it's a hell of a buzzword the last couple of years. And how does it work? What are its risks? And how does it compare to other asset classes?
Okay, sounds good. And I think this is coming in we brought this up because we're having a lot of clients come to us and saying, "Hey, I want to invest in, I don't want to invest in public markets because they're fraught with manipulation.
They're too risky.
They're too risky. I want to invest in private equity, private deals, like, whatever it would be, syndications, private lending, all whatever it would be." Yep. Okay. And there's a lot of, when this is the thing, someone says, "I'll invest in private equity." It's like, okay. Where do you want to start? It's like, it's just it's two words.
Well, private equity is a small sleeve of the total, I guess, alternative investment world.
Okay.
Right. But what is private equity? Do you want to define it, or do you want me to?
Why don't you define it, since you've done so much research on this today?
Yeah. So private equity is just like it sounds. It's investing in non-publicly traded companies. Okay. So private companies that are not traded on any stock exchange. That is what private equity is. Now, when private equity, or I should say, when a firm invests into, when a PE, let's say PE to keep it short, when a PE firm puts money into or makes an investment into a company, it's not, the purpose is not long-term growth. The purpose is, they're basically house flippers for businesses is what they are. It's short, sweet,
big,
take this thing, do what you can to make it look better, and sell it off to someone else for more. That's what private equity is. It's not a buy and hold strategy. All right. Now, with that, and I don't even know if I want to get into this. All right, let's get into it. So,
get into it. Why not?
One of the things that we hear a lot, let's go back to the public markets, right?
Yep.
Everybody has things that are important to them. maybe they don't want to invest in pharmaceutical companies, or they don't want to invest in oil companies because of climate change, or, whatever the situation may be. People like to take their personal beliefs and, implement it into their investing, which is great.
Yep.
Okay. I don't think many clients understand the reality of what true private equity is, because true private equity is, buying a business, gutting it of any expense you can, making that bottom line look good, and selling it off as fast as you can. And that generally involves, gutting benefits, killing pension plans, laying off employees,
That's
selling the hard out. I mean, there was just a case I was just reading about, a company that invests in nursing homes.
Mm-hmm.
They bought all these nursing homes. They sold off all of the real estate. So now all these nursing homes have to pay rent.
Mm-hmm.
They sold off all the real estate, got rid of all the, a bunch of benefits, took out a bunch of loans, and then they declared bankruptcy. Not the PE firm, but the nursing home company.
Mm-hmm.
That wasn't a failed investment, even though they declared bankruptcy, because they already got their money back on all of the real estate sales and loans and stuff. So I'm not saying private equity is immoral. That's not what I am saying. There's definitely a sleeve of it that certainly is. But, you got to understand what you're investing in. And if you're a conscious investor, beware.
It's like Gordon Gekko type stuff.
Yeah.
Yep.
All
right. So I'm trying to articulate a good question here, but where does all this private equity money come from?
Investors, right? They just raise money from everyday people,
from high net worth people.
I should say high net worth, because there's requirements on. So
a group gets together and they create some kind of a strategy.
Yep.
Right. And then they will go out to an industry or multiple industries, I guess, depending on how big the group is. And they will start to buy businesses.
Yep.
Correct?
Yep.
And you as the investor, okay, what is your standing in that particular investment?
Well, you're probably a limited partner. I mean, you have no say in anything. You just
so let's define that first and foremost. Most of these private deals, you are going to be what's called, in business terms, you have general partners, who are the people that really are the operators.
Yep.
Okay, of the private equity fund or whatever it would be. And then you have most of the investors, which are the limited partners.
Yep.
And as a limited partner, you don't have any say over the investment strategy. You don't have any say over when you get your investment back. Nope. You don't have any say over distributions taken. You don't have any say on the frequency of distributions. You don't have any say at all.
No.
Correct?
None.
Okay. You have limited liquidity.
Limited to no liquidity. I mean, most private deals, they give you a target timeline of, okay, we're going to buy whatever asset class they buy. We're going to, raise the profit, and we're going to sell it off in 5 years.
Yep.
There's no requirement that they sell it off in 5 years. They might sell it off in 8 years. They might sell it off in 2 years, but you're not getting your money back till they sell.
Correct. That's right. You're not getting your money, and you can't call them up and say, "Hey, I need to liquidate this money."
No,
because
you're in it to the end.
Yeah. So people have to think this through when you're kind of developing an investment strategy. And again, I don't think it's bad for someone to invest in private equity.
No.
I don't really at all. I mean, we have on our platform, we have private equity offerings, right?
Yeah.
We have the ability to allocate certain money. And again, you have to be what's called an accredited investor to be able to qualify for this, which most of our clients are because they're in that, in that range.
Yep.
But to think that it's gonna save you from risk, to think it's going to save you from volatility, to think it's going to enhance your return potential guaranteed over public markets or your own business or other real estate that you have. I don't know. It just does that part doesn't make much sense to me.
Yeah, I mean, returns from private equity over the last couple decades have been strong.
Yeah. When you say strong, I mean, I guess it all depends.
Very close to the S&P 500.
Okay.
Right. But this is the part that I don't get. When a client says, I don't want to invest in the public markets because I don't trust them, it's too risky, it's this, it's that. The public markets are extremely regulated.
Yep.
Extremely regulated. There's no regulation in private equity.
Not really.
You know, minimal regulation. So, that just doesn't make sense.
Yeah. So to say that your money's going to be safe and it's in good hands, I don't know that. I really don't. I mean, you are literally putting your money in the hands of an operator.
Mm-hmm.
And you better know for sure whether that operator knows what the hell that they're doing or not.
And it doesn't even always matter if they do.
They don't really, because they just may be in a sector or an industry that's doing well.
Like right now is a perfect example. There's tons of private real estate deals, right?
Yeah.
It's been one of the hottest things.
Oh my God.
Most of those private real estate deals that a couple of years ago were generating these phenomenal returns are paying no return.
Nope.
No income, maybe a 2% income. And I'm not going to say most of them, but some of them are
a lot of them
failed upside down.
Yeah.
Money's gone, lost. So,
or they've had to do what are called capital calls, which is basically where they call up the investors
and say, give us more to save us.
To give us more to save us.
Yep.
Yeah. Give us more to save us.
So sometimes it's just timing, right? Like real estate looked phenomenal 4 years ago because interest rates were low. Well, now all those, loans that these companies have they're variable, most of them. And those rates have gone way up. That 2% loan's at 9% now. And that cash flow to investor is gone.
That doesn't mean that the underlying investment was bad. It really doesn't. It may still be, if the group can weather the storm.
Yeah. Oh yeah. They can still turn it around and there still can be profit at the end. Absolutely.
For sure. But I think what I'm trying to say is like people that think private equity strategy is the entirety of your investment strategy. You're going to be disappointed at some point in time.
Oh yeah.
It's not used to, if you're behind on your investments, like that's not the strategy for you.
No.
To try to catch up. Okay. It is, I think it should be used for people that have already demonstrated that they have a business that's really profitable and growing, that they've, own their building where their office is, where they've habitually been saving, a lot of their business profits and building other income streams. And you get to a point where there's only so much you can fund in your qualified plans. There's only so much you can, fund in other areas that you're doing right now. And you have a lot of excess cash left over, right? Yeah. And you're like, okay, I need to do something with this. Okay. Now, Now I would start looking at, okay, I think you're a candidate now to kind of step up the game a little bit and start moving into some private deals. We've maximized the allocation to your public securities. If we have insurance-based products, we've used those. If you got real estate, you've invested in that. Okay. So I think you're ready right now.
Yeah, private equity is not the first place that money should go. It's for people, like you said, that have already maximized the traditional areas and need something different.
Yeah, need something
where it's a fit
that maybe doesn't correlate to what you have right now. That can be truly used as a non-correlated asset.
Yeah, but if you're 60 years old with $200,000 of savings, you don't need to be in private equity.
I mean, not for the entire amount, not for the entire amount. I mean, my God, it's like,
I would say not for any amount.
Yeah. I mean, if that's your strategy, it's like, we got to rethink this. And the other time that I think private equity would be of use is upon a business sale.
Oh, absolutely.
Where you are now in a position where you have a huge liquidity event, where you are now, have $8, $7, $8, $9, $10, $11 million somewhere around there. That doesn't even have to be that much, even like $5 or $6 million, somewhere around there. And we need to allocate something to, this kind of a strategy, maybe for an income play, maybe for a real estate play, whatever it would be.
Yep.
But it certainly would be part of the portfolio at that point in time. But just to think that private equity is going to solve all your investment problems, like the returns on your investment right now, I think it's a mistake.
The returns over the long run, the returns are no better than stocks. The risk is higher. I mean, there's a reason it's unregulated, and there's a reason that only accredited investors can invest, and that's because risk is higher. So,
and just because you're an accredited investor, I mean, I know plenty of accredited investors that cannot afford to lose $50,000 or $100,000.
No, all an accredited investor. I mean, what that statement means is you're worth over $1 million, excluding your primary residence.
Yeah, that's not much.
I mean, you might have a small practice that's worth, $700,000 or $800,000 plus a little bit in retirement and cash, and you might meet a accredited investor, but that doesn't mean that you have any business going to, these higher risk investments.
No, not at all.
So it's a wide net. Accredited investor is a wide net.
Yeah. So it's one of those things where just because someone says that you're an accredited investor, that doesn't mean that your risk is all of a sudden tolerable enough to have to withstand the, what you're going to experience when you invest in some of these private equity investments.
Yep.
And, I'll go back to it. You have to understand the underlying investment first and foremost, whatever it is.
Yep.
Like I just had some people say, yeah, we're going to invest in private equity. I'm like, okay, what is it going to be? But let's just say private lending. Oh, okay, great. Well, who are you lending to?
Yeah.
Who are you lending to? Like, what is the strategy? What's the criteria for the companies that are, it just sounds so good. Like, oh, private equity, private lending.
Oh, it just sounds exotic. That's what people like.
It sounds great. Oh, great. That sounds great. So then what exactly is the strategy? Does this group who is managing this, and they may do a great job, and maybe they, have very strict underwriting criteria as far as who they're going to lend their funds to, okay, to ensure that they get paid. But it's still a transaction where you are lending money to someone, and that you have to make sure that they pay you back with interest. Okay. Yep. And if they do not, then you're going to run the same problems that someone else would, if they lent their money out to their friggin' Uncle Joe to go start, some endeavor. You're going to run the same problems. You're not going to get your money back.
Yep.
It just sounds fancy because you're in a private equity fund.
Yeah. That's the allure. The allure is in the name most of the time.
It definitely is. So the things that I've learned, because we've definitely learned, a thing or two, I think, and certainly the investment into these private deals is not always, going to return you, 12, 15, 18, 20% returns or more,
Yep.
I mean, I invested in a private equity deal back in 2019, somewhere around there. It was a real estate, right?
Oh, it probably worked out phenomenal.
Yeah, it did. It was great. I earned an average return of 29%.
Yeah.
For 2 years. Awesome. It was in the lowest interest rate, greatest real estate boom that we had ever seen.
Yeah.
Okay.
Luck.
And of course, you're going to invest with them again. And I did. Okay. Now, their next fund returned an average of 12%.
Okay.
Which some people would think that's a failure. And some people did. They got pissed.
Yeah.
Because it was like, oh, that's a failure.
That's
I made 20
failure.
I'm like, are you nuts? Are you nuts? You made 12% on your money.
Yeah, that's nowhere near a failure.
Okay. And then of course we did another investment. And now, that one was more of where the property was bought in the 21 range, 2021.
Yep.
It's, the distributions are lower. They're trying to manage the cash flow because of the environment that we're in.
Yeah, their interest on debt has gone up dramatically.
Yeah. So, but I trust them as operators that they're going to be able to navigate this and know what they're doing.
Yeah.
Okay. But I guess my point is that you guys have to think, all right, just because someone says I'm investing in private equity, great. What kind of investment is it? And then do your own research on that industry and where is that sector going? And what are the factors that drive success in that sector that you're investing in?
Yep.
And if not, then, you're just going to experience whatever, you're going to get, I think, at that point.
Yeah.
But I thought you had some stats on private equity, and then a lot of deals in private equity. I think that you're probably going to have I don't know if it's a higher rate. I did hear a stat a while ago that a large percentage of private equity deals go bad. I don't remember the number, but
I want to say, let's see here. I'm looking this up if I'm being honest, because I don't know. 1 in 5 private equity owned businesses fail.
20%.
Yep.
20%. So anyway, I'm not saying, look, we just invested in a private equity deal. We just did with some company cash. Right.
Yeah.
But obviously it was strategic and it was done because, I had confidence in the operator and the strategy and all that stuff. But you have to think this through. And just because you got 200,000 or 300,000 or 500,000 sitting around and you think that you're smarter than the next bear or the next person, say, well, no, I'm not going to invest in the public markets. That's for fools. That's for suckers. That's for whoever. We're going to do private deals because we're cool.
Yeah.
Yep.
That's all it is.
Just beware.
That's all it is.
Just beware. All right. Anything else on that?
No, I mean, I Yeah, no, I think that pretty well covers what private equity is, what the risks are, all the important stuff.
So to kind of recap, private equity is where private investors invest. You can invest, obviously, as an accredited investor. You're a limited partner, and generally speaking, there's an operator who's the general partner that will manage the operations in the fund. They will provide you with, there's a strategy. They go out there, they try to, buy these investments, whatever area they're going to be in. And then at some point in time, the target is to flip it so that it's not a long hold period. Let's just put it that way.
No.
3 years, 6 years is probably the max that I've seen for most of these groups.
Yeah, the average is like 3 to 5. So yeah.
And then the money flips, and then you're off to the next strategy at that point in time.
House flipping for businesses.
House flipping for businesses. Okay.
That's it.
Okay, so beware. Make sure that if you guys do want to invest in private equity, that you're going to do it with professional people that have strategies that have been culled and due diligence has been done. Even then, it doesn't, there's no guarantee that you're going to hit, big returns on these things, because a lot of it has to do with the market environment that we're in. Okay.
Oh yeah. Some of the biggest private equity groups right now, like Blackstone, they're writing off deals as complete losses.
Yeah.
They're not going to fail.
No.
Blackstone isn't going anywhere, but investors in those projects
are going to lose money,
are out their investment.
Yeah. So, I mean, it is possible, because you guys didn't think of the underlying investment and really analyze what that was. You just thought because it said a private equity deal that it was foolproof, and it's not.
Nope.
Okay. So just be careful and make sure that you're doing the due diligence on that if you're going to invest in that area.
All right.
All right, dude.
Till next time.
Till next time.